Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday.
Hello and welcome to this week's episode of the Prime Property Finance Podcast. My name is Mark and in today's episode we're going to ask the question, can we tolerate any more instability? Now it's not meant to be a negative question. It's a genuine question. We've obviously gone through, or we are going through, instability in terms of the conflict in the Middle East. And now we are on the verge of a leadership challenge or a change of leadership. So I just wanted to ask, what does that actually mean in terms of where we are and where we've been? And what are the opportunities that it presents and the potential risks as well? So let's have a bit of a dive into it. Now, what triggered this conversation was an article that I was reading earlier today around the potential for a change in leadership. Before I come on to that, I just want to sort of rewind a little bit and catch up as to where we've been over the last few months. Now, we've been through a lot this year in terms of various different bits and pieces. We've had the Renters Reform Bill that's just come in. We've had quite a lot of instability over the last couple of months, but prior to that, it was relatively stable. That is in terms of what we've been through the last few years. So not what we would have been used to 7-8 years ago, but certainly versus where we've been in the last 18 months. We had a period of stability. Now, obviously the conflict started in the Middle East and that sent mortgage rates crazy. And why is that? Well, the swap rates, which influence the fixed rates, are basically a hedge against where they think interest rates are going to go. So any form of conflict or instability or uncertainty in a marketplace will ultimately find its way into those, which will then in turn find its way into your mortgage interest rates. So without doubt, the conflict in the Middle East has been a major impact on borrowing costs for landlords and mortgages in general. And we are still bearing the brunt of that. It's still quite volatile. It's still unresolved in terms of what's going to happen. Although, to be fair, it's much, much quieter in terms of the press. Therefore, we aren't hearing so much of the negative side of that at the moment, because there's other stories that are dominating the news at the moment. And that one is the bit that I want to come on to, is the bit around this potential leadership challenge. So where are we with this? Obviously, Keir Starmer, our current, as of today, is our Prime Minister. And he's had a bit of a tough time of it for a while now. He's been involved in scandal after scandal and challenged numerous times. So his leadership has come under pressure a number of times. So I kind of feel sorry for him in one hand, in that he's had to deal with so much and his other cabinet members have let him down. But on the other hand, kind of you reap what you sow, so to speak, in that regard. But anyway, that's a political thing. We'll park that to one side. What this episode is about is ultimately having a look at what a leadership change could potentially do to the mortgage market. And what does that mean to you then as potential borrowers? So already, and we don't have a leadership challenge currently, but already on the hint of a leadership challenge, we've got Andy Burnham's going to win his by-election yet. We've got Wes Streeton has said that if there is a leadership challenge, he will stand, but he hasn't actually triggered a leadership challenge directly himself. But already, with the potential news of a leadership challenge, the gilt market has reacted. So the 10-year gilt rate rose by 18 basis points, up to 5.18%. And then the 30-year gilt rate rose by 19 basis points, up to 5.85%. And the pound subsequently got weaker against the dollar. Wonderful. You're thinking, what does that actually mean? Well, what it means is the cost of borrowing is getting more expensive, not just for the mortgage market, but also for the UK government. So if that's going up in there and the government is seen to be a stable place or a stable borrower, then you can see how that can manifest itself into other rates. So You may say, well, Mark, Bank of England base rate hasn't really changed over the last few months. They've all decided to hold. However, the Bank of England base rate is only one barometer. And we've spoken about how rates are influenced in previous episodes. My point here is the uncertainty of who the Prime Minister is going to be is creating volatility in the marketplace again. Now, whether you agree with the candidate that's going to win, you agree with their policies or otherwise, is for you to debate amongst yourselves. However, it's this uncertainty that we're experiencing around who is going to come in, or what's the policies going to be? Are they going to spend more? Are they going to save more? Are we going back to austerity? What are all these things going in? And the fact that we don't know those answers are what's creating this shockwave, if you like, into interest rates as we see it. Okay, so when you overlay that onto a market that's already been quite volatile because of what's been going on in the Middle East, obviously the interruption to oil supplies, fertilizers, and so on, we invariably are going to find inflation going up. Now, inflation going up is not a great thing for anybody. So the cost of living is already under pressure, as we could all feel it. But if you add more inflation onto that, then we've started to have a serious problem. Then the only instrument the Bank of England have really got to control inflation is base rate. Base rate goes up, rates go up, and so on and so forth. So you can kind of see how this can become quite an untidy place for people who need to borrow, who rely on debt really for their investments. That isn't to say that this is all doom and gloom. There is a number of things that can come off the back of this. And if you are somebody who is an active investor, then there are going to be people or investors out there, landlords, who have deals that no longer work for them, however, may well work for you. So I think this is going to create some opportunities for individuals. We have already seen the tightening of regulations means that a certain population of the landlords are exiting the space because they just don't need the headache of it, and they're moving away from it. We already know this. We know that portfolio sizes on average have gone from about 7 per portfolio now up to 10. So there's been a consolidation of some description where the portfolios are getting larger and the accidental landlords are vacating the marketplace. So we've definitely seen some of that going on. So what we will then see is, if you are an investor, there are potentially opportunities out there where these are investment-led properties that you may be able to purchase at an investor's discount, if you like. I don't like to say below market value because it's worth what you pay for it, but certainly an investor discount is something that may well be attractive in that sense. So I think it's going to create opportunity with that. Now, what if I'm a landlord? What if you're a landlord that is not actively seeking anything, however, is concerned about interest rates? Well, there's a couple of levers you can pull, I suppose. I guess it depends where you are in your debt cycle, whether you fix for 5 years, 2 years, or want for variable rates. So if you are somebody who's on a variable rate, then you may want to consider moving across and fixing a rate for a period of time. That will just remove all the volatility. Now, it's not about trying to get the best rate for the next 10 years, okay? It is literally having stability built into your forecast when you go look forward. So you know that your rent is, let's say, £1,000 a month, and your mortgage is fixed now for the next 5 years, and it is going to stay at £500 a month, let's say. As I say, that is not a conversation around what's the best, am I going to get a lower rate next year or so on? That is literally stability. You've just hedged the next 5 years, basically. So all of this going on is ultimately not going to impact you, and you don't really have to think about it for another 4 years necessarily. So that's one of the things you can do. If you're in a 2-year, then again, similarly, you may want to consider fixing for the longer term. We know that obviously we've got the conflict. We know there's going to be a lag in terms of the conflict. In terms of the oil supply, fertilizers, the absence of fertilizers is anticipated that we'll see a lot of food inflation next year. Therefore, there are going to be impacts on cost of living, interest rates, and various bits and pieces there. So taking yourself out of the game in terms of not having to worry about it means fixing again for a slightly longer period, 5 years. Now, when you compare it to what they were 3 years ago, yes, they're going to be more expensive. But look at the environment that we're in. You're going to pay more for that money. However, as I said, in terms of going from a variable, locking it in for 5 years just takes you out of this conversation for 5 years. So if you do get a change in leadership in the next 12 months, there's also going to be some instability because you just don't know what you're going to get from that actual leader and what the anticipation is going to be, as I say, whether they're going to be spending and so on. So we're going to still remain in a period of volatility for the foreseeable future, in my mind. Therefore, fixing for that longer period makes sense, and you can just forget about it and concentrate on other parts of the business. Okay, if you're in a 5-year fixed rate, then again, I would probably just have one eye on where you're going to be. Now, that depends, of course, on when it's due to mature. If it's due to mature in the next 12 months, then the question that I would probably start asking myself, is it cheaper for me to come out of my rate and pay the early repayment charge and lock in at today's rates than it would be if the rates went higher and I then had to lock in at 5? Because I think that the way forward is to lock in for 5 years. But the question mark would be, is it worth me getting out of this deal now to lock into a rate if I anticipate them to be slightly higher or higher over the next year to 18 months when your rate is due to mature? There's no crystal ball with that. I think there's a few things at play there. It depends on how much your mortgage is, depends on what your early repayment charge is, depends on your existing rate. If your existing rate is 3% lower than anything you can get right now, then it doesn't make sense to then go and pay an ERC at another 1%, that's 4%, and you're not going to make a 1% saving per annum. The rates are going to have to go up substantially for you to save that. So there's a conversation to be had around that as to whether it makes sense to pay the ERC, get yourself out of a deal and get back into one a bit sooner. But again, it depends on your portfolio size, how many of those deals are going to fall in, what does a 1% increase in interest rate actually look and feel like, and then you can have that educated guess, I suppose, in terms of what's going on. The one thing that I do think we're going to have, though, is that volatility. So I do think there is certainly a thought process that brings that really to the front of your thinking if you're in that position at the moment. So in terms of the overall position, as I say, if you're already in property and you're not looking to acquire, then it's probably one of those three things to do with your interest rates. Cash reserves are going to be key, I think, as we've been saying for some time now. So making sure that you've got healthy cash reserves wherever possible. Voids, I did an episode not that long ago about, is our interest rates the be all and end all? Now they clearly are important, otherwise I wouldn't be speaking to them about them now. But there are other things in property that can be far greater an issue than having an extra 1% on your interest rates. For example, void periods, having your property damaged by tenants and so on. So don't just concentrate on interest rates. Look at your property portfolio as a whole, understand where your biggest risks are and look to mitigate those wherever you possibly can. Okay, so as I say, interest rates are exceptionally important. However, they're not the be all and end all as to whether your property is going to be successful in terms of your returns. And also your own set of circumstances. You may not be looking for your actual returns right now. This may be a future investment led. Your objectives are different and so on. So my point here is the volatility, and you will have lots of headlines around this is going to happen. That's going to be the end of the world for this. That's going to have that. That's going to be a lot of rhetoric. There's devil in that detail that they're probably not sharing, which is not all doom and gloom. And again, try and overlay that information to your specific set of circumstances. Don't just get drawn into the end is now. It's going to be 10% mortgage interest rates. You can't afford it and so on. Just apply some logic, use your set of circumstances to understand what the impact of any of this is going to mean to you as individuals. But as always, you've got this far, and we've been through a hell of a lot more than a change of leadership over the last sort of 10 years. So just bear that in mind. We're resilient in our approach as investors and people. We'll find a way. Have a line of sight, understand what your levels of tolerance of risk are and what you can afford to absorb. Once you get close to that level, then that's the consideration as to whether you exit the property or so on. Okay, so hope you find that useful. That's just a quick overview from me, or I guess my opinion on what I think we're going to see over the next 12 to 18 months with the political landscape and also the macro environment, as I say, especially around the conflict. Hope you find that useful and insightful. As always, I don't have a crystal ball, but that's just my thoughts. If you'd want to chat around it further, then please let me know. You can get in touch. And I hope you find that useful. Thank you very much. I shall see you on the next episode.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.